On May 6, 2010, something happened that markets were never supposed to do. In a matter of minutes, prices began to fall at a speed that defied logic. Nearly $1 trillion in market value briefly vanished, and confusion spread across trading floors and control rooms. Then, almost as suddenly as it began, the market steadied. What could cause such a violent collapse in such a short time? Was it a system failure, a chain reaction, or something far more deliberate? As investigators began digging through mountains of trading data, the trail led somewhere unexpected, not to a major institution, but to a single trader working quietly from his home. Long before his name entered regulatory reports, Navinder Singh Sarao was working alone, far from the noise of major financial institutions. From a modest home in West London, he spent his days studying market movements, focusing on futures tied to the S&P 500 index. He was not part of a large firm, and he did not operate from a busy trading floor. His environment was quiet, controlled, solitary. Yet his attention was fixed on one of the fastest and most complex financial systems in the world. Sarao believed markets followed patterns. He watched order flow closely, tracking how prices reacted to sudden shifts in buying and selling pressure. Over time, he built automated tools that allowed him to place and withdraw orders at high speed, faster than manual trading could ever allow. To outside observers, his activity appeared routine, but inside the constant movement of the futures market, subtle patterns were forming, patterns that would later draw the attention of regulators searching for answers. Navinder Sarao spent years studying how markets reacted to pressure. He focused less on headlines and more on the flow of orders moving through the system. In modern electronic markets, visible orders can influence behavior. Traders and the algorithms they rely on often react not only to completed trades, but to the appearance of supply and demand. Using custom automated tools, Sarao began placing large sell orders in the futures market. These orders created the impression of strong, downward pressure. But there was a critical detail. Many of these orders were never meant to execute. Instead, they were frequently adjusted, moved, or canceled as market conditions shifted. The strategy depended on speed and timing, allowing him to influence short-term price direction while limiting direct exposure. To most observers, the activity blended into the background noise of high-frequency trading, where thousands of orders appear and disappear every second. Individually, the signals looked small, but repeated over time, they began to ripple outward through the system. On the afternoon of May 6, 2010, pressure in the futures market began building unusually fast. Large sell activity appeared. Within moments, automated trading systems across the market began reacting. Algorithms designed to respond to sudden shifts in supply and demand accelerated the movement, feeding into one another as prices dropped further. What began as localized pressure quickly spread beyond a single market. Major indices fell sharply. Stocks lost value in seconds. For a brief moment, normal trading behavior began to break down. Liquidity thinned, orders struggled to find balance, and confusion spread across the financial system in real time. At the lowest point, nearly $1 trillion in market value had briefly been erased. Then, the market began to recover. The speed of both the scoot and the rebound left regulators facing a difficult question. What had just happened inside the world's most advanced financial system? In the days that followed, regulators and exchanges began reconstructing the event in extraordinary detail. Billions of data points were examined, order placements, cancellations, execution timing, and interactions between automated systems. Early theories focused on market instability and algorithmic feedback loops, but analysts soon noticed something unusual. A pattern of large sell orders kept appearing in the data, placed, adjusted, and withdrawn in ways that influenced market behavior without always resulting in completed trades. And the same source kept appearing in the records. Slowly, the trail narrowed across systems, across exchanges, until it pointed toward a single trading account operating from London. Years after the crash, following extensive analysis and cross-border cooperation, authorities identified the trader behind the pattern. In 2015, Navinder Singh Sarao was arrested in London at the request of US regulators. Investigators alleged that his strategy involved placing large orders designed to create false signals of market pressure. a practice known as spoofing. The revelation surprised many. The disruption that had shaken global markets was not traced to a major institution or coordinated group, but to a single independent trader operating from his home. In the years that followed, the case moved through courts in both the United Kingdom and the United States. Sarrao eventually admitted to manipulating market activity through spoofing and later cooperated with authorities. Regulators responded by strengthening monitoring tools designed to detect unusual order patterns. Circuit breakers and tighter surveillance of algorithmic trading became more central to market stability. The flash crash remained a defining moment in modern finance, not only because of the speed of the drop, but because it exposed how sensitive high-speed markets had become. In systems driven by speed, automation, and perception, how much influence can a single strategy truly have?